Since we spoke, of course, last night in the early hours of the morning in UK time, we had that response from Israel in this ongoing conflict between Israel and Iran. But very interesting to see how markets have changed over the last, 12 hours or so, because initially I was looking at 3 a.m. UK time. We saw oil, for instance, go up to around about $91 a barrel for Brent, but now it's gone right back to 87, and 87 is the levels we were at the end of March. Very interesting to see that. I know there are other market repercussions, but what is it about what's happened over the last few hours that have really calmed markets and seen the oil price fall so much?
Yeah, that's a great question, Johnny, and I'm sure a lot of people woke up today with the same question. They went to bed seeing the oil market, skyrocketing, and then woke up and it was back lower than where it started. Not to mention the same thing happened with the stock market. Stock market dropped, kind of the inverse effect, dropped immediately in reaction to this news, and then has progressively bounced back. That being said, we'll get to stock market in a minute. It's also having now a little bit of a troublesome day. But yeah, specific to the oil side of things, the oil market jumped up big time off of course, its usual jump, which is geopolitical escalation or tensions rising, whether it be in the Middle East, Ukraine, etc. This, of course, the strikes that occurred late last night, depending on where you were in the world. Anytime you get this sort of news, it does cause an immediate reaction, and these reactions are usually violent because it's not your standard, reported news like we might get from a CPI report. These are usually things that have a lot of question marks, and people are scrambling to find out what's happening and how severe this is and whether or not it escalates. So usually you see that fear of the unknown caused these massive moves. I mean, oil was up 4+%, which is a dramatic spike. That being said, why the drift back lower? Well, there were also reports that Iran minimized the effects of the Israeli strikes, whether that be a move to diminish how seriously damaged things were or not. Regardless, had they come back with a swear of vengeance, the market probably would have gone much higher for oil. The stock market would have sold off much lower. So that minimizing effect, regardless of the intentions behind it, have cooled the market a little bit since then. But again, that being said, oil still remains overall, you take a look at it like on a weekly chart, it's still up this year pretty substantially. Yes, it's given back some, as you mentioned, going back to like March numbers. But still, a rising oil price, which has contributed to a lot of what we've talked about on the podcast recently, Johnny, that resurgence in inflation, the problematic, the problem the Fed has to deal with, as well as other places in the world. And, that higher for longer story that perhaps is scaring the markets a little bit today.
And of course, global economies are going to be very relieved to see the oil price falling despite that action overnight, because all eyes are on the inflation numbers. We've had UK CPI this week, which wasn't as good as expected. And like the United States, the Bank of England has indicated that it's going to be higher for longer as well. So we're going to talk in a moment about the S&P and how it's reacted over the last few days. But in terms of interest rates, where are we now?
Yeah, so yields are on the day slightly lower, but of course, when that immediate reaction that we talked about to the strikes last night occurred, there was an immediate rise in the price or value of bonds. Of course, that's indicating yields dropped. Yields dropped pretty quick because, again, it's a bit of a flight to safety going into treasury bonds. That being said, the effects were not enough to, I guess, sustain. This is generally, in markets, we see this kind of be a recurring pattern. You get geopolitical news, market spikes, and then it spikes back the other way. Same thing with yields. Yields came down pretty heavily on the 10-year and the 20-year, but then have bounced back since that. I think what happens, Johnny, is what happened, like the market freaks out about something, but then it goes back to, well, what's really going to sustain this direction one way or the other? Now, of course, if you had a full-on war breakout that was much higher, then yes, then that would take precedence over everything else. But right now, the story has been and continues to be, what's the Fed going to do, and how high are interest rates going to go? Well, again, we see the 10 years at 4.6. It's creeping higher, does not seem to want to cool off, and as long as that is continuing to rise, it starts to create a little bit of a troublesome story. I know we're about to talk about stocks, so when we have rising yields, suddenly, you have geopolitical tension, you have uncertainty in financial markets, earnings or company valuations are high. Some people might be starting to think, and when I say people, I'm talking about funds, pension funds, money managers, individuals.
They're people as well,
Yeah, they're people, sometimes they don't feel like it, but yes, you're right. They are people, and they have this decision to make. Are they going to put money, whether it's their own or their clients, into something that is more risk adverse, like a long dated treasury bond, or are they going to stay and take that risk in stocks? And I think that the risk to reward is becoming a little less attractive right now. If you enjoyed this video from the Market Insights Market Pulse podcast, you can listen to the full episode by clicking the link down below in the description. You can find us on your favorite podcasting apps, and again, we post several times a week, so if you're looking for market updates throughout the week, this is the place to be. Whether you're in the car on the way to work or something like that, make sure to tune in to get the latest. Thank you very much for watching. We'll see you on the next one.